Hello and welcome to the Global View on this Friday. Well, the Bank of England and the European Central Bank have held borrowing costs steady while pledging to keep monetary policy tight as long as necessary. The Swiss National Bank also held rates steady but lowered inflation forecasts, while Norway's central bank surprised markets with a rate hike, citing persistent inflation that is likely to keep rates elevated until late next year. In contrast to the outlook from the Federal Reserve, ECB President Christine Lagarde emphasised that inflation would soon rebound and price pressures remain strong, saying, "We don't think that it's time to lower our guard. There's still work to be done. That can very much take the form of holding rates." Bank of England Governor Andrew Bailey said the fight against inflation continues, saying successive rate rises have helped bring inflation down from more than 10% in January to 4.6% in October. But there's still some way to go. We'll take the decisions necessary to get inflation all the way back to 2%. Now, in the US, retail sales unexpectedly rose in November, up 0.3% after falling in October to be 4.1% higher year on year. US Treasury yields have fallen further, with the 10-year yield sinking to its lowest level since July, below 4%. The 2-year down to its lowest level since May at 4.28%. And the rate futures market now pricing in an 81% chance of a Fed cut in March and 140 basis points of easing by the end of next year. Currency-wise, the euro hit a 2-week high against the US dollar as the ECB pushed back against imminent rate cuts, and the US dollar has tumbled further against most major currencies, with the Aussie dollar now having touched 67 US cents. Well, let's now take a view on China's economic growth and its credit outlook. To do that, we're joined by Zelina Zheng from Credit Science from Singapore. Zelina, very good to catch up with you again. Thanks for joining us. All right, so let's take a look at the picture that China's presenting at the moment with market consensus essentially for GDP growth of some 3.9 to 4.5%. Does that differ from your outlook?
Right now, the market has been very pessimistic on the growth look of China in 2024. We just had a conference in Singapore, and among the respondents, it feels like investors are looking at the number of below 4% for next year. Our house view is we think the growth is going to be above 4% and around 5% for next year for a few reasons. The first one is we think the policy implementation is going to be more effective next year. The second one is being the infrastructure stimulus is going to get rolled out quite effectively across different local governments. Third one is if you look at the inventories of a lot of the manufacturing sectors as well as the metals and minings, it has been at historical low levels. So we think you should not ignore the effectiveness of the inventory restocking across the industrial supply chain. And lastly, as we think the monetary policy is going to be very accommodative heading into the new year.
Okay, so you're actually looking for more rate cuts then?
Yes, we are looking for about 10 basis point of additional policy rate cut. That is the reverse repo rate as well as the medium-term lending facility rate. First one as targeting towards the medium and smaller sized enterprises and targeting towards some of the privately owned enterprises in strategic sectors. The second one is more targeting towards the home mortgage rate. As you know, the China's property downturn is still ongoing, and the government is really trying to stimulate the confidence of the home buyers.
Yeah, I note there, Zelina, that you take the view that perhaps the property sector is likely to be a smaller drag on the Chinese economy going forwards. Why is that?
Yeah, we do get a lot of pushbacks from the investors in terms of this view. Most of them are saying, if you look at the stimulus policy towards the property sector, it has been ongoing since 2021, yet we are not seeing the new home sales having a very significant rebound. We think this is quite different this time around for two reasons. The first one is if you look at the demand side policies, in 2021 and 2022, a lot of them are rolled out by the local government and they are very fragmented. But starting in August this year, it is driven by the central government, and a lot of the policies such as mortgage rate cuts and home purchase easing or these policies are driven by the central government, top down and nationwide. So this is quite different, and we are expecting the effect to flow through into the real economy in 2024. The second one has been we are also seeing a lot of property funding support directed into the property developers. In the past, a lot of the rhetoric is about you need to ensure the home completion, you need to ensure the home buyers getting their home deliveries. But when it comes to the debt servicing of the developers, it's not as a top priority for the policymakers. But starting in September, we are seeing the funding support going to the holdco level of the property developers, and some of them are heading to the debt services.
Yeah, I do note, though, that you're looking at perhaps medium to longer term. There remain those issues there, particularly as it relates to unresolved local government debt, which you're saying is still a little opaque at the moment.
Yeah, correct. I think over the medium to long term, China's growth picture is more unclear because some of the structural challenges faced by the economy, one is, as you just mentioned, the local government hidden debt. The central government has been doing some proactive measures in terms of rolling out 2.5 trillion RMB of debt swap to ease the liquidity condition of the local government financing vehicles. Over the short term, this is going to ease some of the systematic risk arising from these hidden local government debt, but over the medium to long term, we are not seeing a very concrete or comprehensive resolution for this risk. Other structural challenges for the economy includes, population aging and the unresolved the property inventories within the system, as well as the new growth drivers to replace the property for the economy.
Zelina, you also point to the prospect of reduced geopolitical risk. What's your reasoning for that?
Yeah, I think if you look at the recent news headlines, China has significantly softened their external stance. There has been a lot of visits by the top diplomats and top government officials to the Western markets about attracting foreign direct investment, and some of the suggestions in the recent Central Work Economic Forum, even about upgrading some of the institutional settings and framework to facilitate this flow of capital and talents into the Chinese economy. I think this is a good direction for the government to redirect foreign capital into the economy, and we are seeing some early sign of recovery of this. And if you look at the onshore government bond market, corporate bond market, we have seen the inflow back into China since August this year. So I think when we heading into the new year, where we might see an increase of foreign capital into the Chinese economy.
Zelina, I gather just recently the Central Economic Work Conference was held. What was the upshot there? What came out of that?
Yeah, so this Central Economic Work Conference is one of the most important Politburo meeting for the Chinese economy. It basically sets the growth priorities, policy priorities for 2024. I think one thing worth noting is the policymakers have been quite candid this time, acknowledging a lot of the challenges facing the Chinese economy, which we think is a good first step in strengthening the Chinese growth and stabilizing the economy in the new year. Secondly, it also pushed out some of the concrete measures in terms of how you are going to stimulate the economy into the new year. A lot of it is about supporting the funding of the high-end manufacturing, about supporting the SMEs, directing capital again to the privately owned enterprises. It also talked a bit about the property sector. I think it is quite interesting to note that the policymaker, they subtly admitted some of the previously rolled out policies were a bit too aggressive, and now they really need to re-stimulate the property sector using some of the public fundings, such as directing government fundings into the social housing and urban renewal projects. So overall, I would say the growth tone, the pro-growth tone is still very strong in this policy meeting, and we are looking to additional fiscal stimulus policies into the new year.
Okay, so Zelina, overall then, what's the credit outlook then for China? I note that Moody's revised its outlook for sovereign credit rating to negative from stable. What's your view?
Yeah, we are not too concerned about Moody's negative outlook. I think the rating agency cited mainly two reasons. The first one is being they think the central government is directing more fiscal funding into the local government, and that might weaken the overall, the debt servicing capacity of China, which we don't agree. We think this is a right step to address some of the systematic risk within the Chinese economy by easing the liquidity condition of local government financing vehicles. To some extent, you are reducing the overall risk of the banking sector, at least for the short term. Second one is the rating agency has been very pessimistic on the Chinese economy for next year. They're looking at something below 4%, which we think is not very realistic, given all the fiscal stimulus and monetary support policies flowing into the economy. So overall, we are still quite constructive on the Chinese economy, and we continue to see opportunities in Chinese dollar bonds. I think for equity investors, it hasn't been a very impressive year. But if you look at on the credit side, the spreads of China investment grade dollar bonds have actually tightened quite aggressively throughout the year, mainly because of technical factors, because basically we are not seeing new supply in the China dollar bond space this year. I think the situation is probably going to continue next year because of the Fed is going to reduce the policy rates, but we don't know when. And for the Chinese corporates, it doesn't make sense to issue in dollar because of the high funding cost, and a lot of them are still looking at the onshore market, so the supply is going to be limited. So for next year, we are still looking at the China spreads trading tighter to sideways. And I think one thing interesting to note is the volatility of China dollar bonds is quite low. So for the portfolio managers, it's a good addition to your portfolio and reduce your volatility and increase your return on the volatility adjusted basis.
Selena, thanks so much for your outlook on China from CreditSights. Thanks for joining us.
Thank you.
All right, that is the global view. On this Friday, just before we go, a check of the market when we get going in just a couple of minutes' time, looking for another positive session. SPI futures up around 2/3%. Stay with us, the open is just around the corner.